Welcome to Fintech Daydreaming, the podcast that dives into the world of banking technologies and the ever-changing landscape of fintech companies. We bring you real-life examples from global and local thought leaders, as well as experts working within the financial industry, and seek out the best stories from the front lines of financial services innovation, where dreams of industry pioneers meet reality. Hosted by Paul Krogdahl and Ville Sointu. This is Fintech Daydreaming.
Hello and welcome to episode 2 of season 4 of Fintech Daydreaming. I am Ville Sointu. I am here again with you today, joined by my good friend and co-host Paul Krogdahl. Paul, it's a bit of a rainy day here, at least in Espoo. Does it mean that the summer is finally over?
I hope not. It is starting to feel like that. I've got to admit, it is starting to feel like summer is slowly fading away. But I remain hopeful that we'll have a few warm days yet before we start seeing that snow coming in. Yeah,
my summer vacation is over this week, so I think I'm gonna at least kind of maybe lose a couple of kilos of weight that I gained over the summer. Nobody go and compare the YouTube videos from six months ago compared to today. So let's keep it polite here. But enough of the chit chat. As always, we are here to introduce you to another fantastically interesting guest, which is Nitin Gaur from IBM today. So, Nitin, why don't you start by introducing yourself a little bit, and then we'll start talking about all things decentralized finance.
Of course. No, thank you so much, Paul and Ville, for the invitation. A quick intro. My name is Nitin Gaur, and I currently serve as Director of Financial Sciences and Digital Assets at IBM. I also had the honor of founding Blockchain Labs. This is early days of 2013, 2014, when it was fairly new for the enterprise, especially. And then I realized that we were solving for databases, and I then took the liberty of founding the Digital Asset Labs to bring the notion of digital assets. So I've been very fortunate, at least inside of IBM, to be able to do all these interesting things and continue forging ahead, even though, like any large corporation, we have our own constraints in terms of what we can do and what we cannot. So glad to be here and glad to share that perspective of almost, I think, about 9 years of the work we all have done collectively in the space.
Great stuff. And we did warn you about this earlier, Nitin. So we have a tradition here in our podcast to tell a fintech related joke on each of our episodes. As a matter of fact, it turns out it's one of the favorite segments for our listeners. We get a lot of positive feedback about this, even though the jokes tend to be fairly bad. So for this season, we have actually turned this a little bit around and asked our guests to give a fintech related joke if they have any. So do you have one for us today?
Paul told me about it. I have two, not one. So okay. I'll start with the first one, and if it sticks, I'll start the second one.
Okay.
So it's interesting that in digital asset space, we formulate everything around digital, at least in the enterprise space with large banks. It's about digital asset management, and which in short stands for DAM. And so it's easy to say, where are the DAM people? Where are the DAM project manager? Where are the DAM, So it makes it easier that you're not exactly cussing and you're not actually using foul language, but it becomes a part of your vernacular that you can use, and it's perfectly acceptable to say, hey, it's short for digital asset management. No pun intended from that perspective. So that's one. If you like it, I'll go for the next one. If not,
go for it.
Absolutely.
So the next one is, what is the answer to transparency and openness networks and solving all of the world's problems? And the answer is always blockchain. So no matter what the question is, we say blockchain will solve it, and we move on with the conversation. So that's something which I think I've encountered that over and over again in many conversations.
Fantastic. Yes. Actually, Ville, if you don't mind, I want to interject with a small thing. It's not actually a joke, but this was so fantastically sweet from one of my children during the holiday period. We were talking about the podcast, and my kid turned around and started talking about fintech, but had misunderstood the whole area of fintech and assumed that because we're in Finland, Finn was Finland. So it was Finland tech. And I actually had to point this out. Actually, no, it's not Finland tech, it's financial tech. And my child was actually very, very sad and disappointed and almost embarrassed about it. So I think we need to rebrand this to being Finland tech.
Couldn't agree more. And I've actually used that sometimes. You know, you cannot do fintech without the Finns, right? So that's the thing we tend to say in conferences.
Works fantastically, and that
Indeed.
will make my child very happy. So, you know, for the rest of the world, we're focused on Finland tech from now on.
Exactly, and Santa Claus is from Finland as well.
Yes.
So remember that as well. So
And
we have two things now.
You know, we're talking about DeFi, so I'll say this, that Linux came from Finland, the Linux to all this, and Aave, which is one of the most prominent, is also from Finland. So in many ways, it is. You can't have fintech without the Finns. So I can see.
Exactly. So Nitin, you kind of took a head start on the topic of today, which we want to talk about, and I also mentioned that in the introduction. And that is actually something kind of a big, almost like an elephant in the room that we haven't really talked about on our podcast before. So we have talked a lot about central bank digital currencies, stable coins. We've talked about cryptocurrency. We kind of went through the whole Bitcoin narrative many times. We've talked about the problems in the crypto space, but we have never really touched a very big part, a growing segment of the blockchain and digital asset space, which is a topic called decentralized finance. Now, decentralized finance is a very, let's say, fast-growing segment, like I mentioned already. Seems to be gaining a lot of attention now from the regulators, from different kinds of speculative investors, and of course the people who have been working in this crypto space for a very, very long time. But I think let's start from the beginning a little bit. So to take a step back for our listeners who might not be familiar with decentralized finance and what it actually means, and who better to kind of maybe walk us down that path than Nitin, who has actually been working in this space for such a long time. So Nitin, what is decentralized finance or DeFi, and why is everybody talking about it?
No, that's a great question. It's great to start with basics, and I'll give you some of the genesis of how this came about. So we early on had cryptocurrencies, which sort of became its own liquid assets which is Ether and Bitcoin of sorts, which allowed for a medium of exchange mechanism. They then morphed into store of value, and they begin to look like currency, and hence the term cryptocurrencies. And all this was great till we begin to innovate on top of these layers, which were layer one protocols back in the day. And the foundational difference between, I think, is the fact that you go to a bank and you go to a centralized financial institution and they provide some basic, sort of banking services, financial services. You work for one, so you understand that I will validate your ID and I will then give you a basic account, which will let you deposit the money and then lend and borrow and make payments, and then move up to a higher level of financial instruments, whether it's going to security settlement and buying properties. So you realize that if I'm relying upon a bank, I have to rely upon a centralized institution for me to perform all these functions. And the notion of decentralized finance came into existence, which relied upon some of the elements of the fact that I can rely upon a Lego block structure, that I have the base layer platform, let's say Ethereum, for instance, and on those base layer, I have various Lego blocks that rely upon those things, which means I can do payments. I can have projects, which I discussed a few minutes back, Aave, which provides some of the elements of liquidity pooling and automated market making, the borrowing and lending of certain crypto collaterals. So you realize there's not one single entity, and I'm relying upon a foundational layer, let's say Ethereum in this case, while there are many of the other layers popping up. And you have many of the innovative financial products that sort of layer on top of each other. So there's not one single entity in control, which allows me to do a few things. It allows me to navigate and find the best of breed solution, that no longer I'm tied to a single financial entity, no longer I'm tied to sort of having one entity to perform my payments, perform my accounts, perform all the other functions. I'm then reliant upon finding the best of breed solution that can give me best yield, for example, that can give me best returns for my investment. And so DeFi enables the Lego blocking of all those financial services, envisioning sort of capability that me and you can create our own banking services, should we choose to, or we can choose to stick with one single banking service. And that choice framework, in my opinion, is what DeFi highlights, if that makes sense. So I'll take a short pause, and this is a discussion, so I'd love to get your thoughts to see if that resonates with what you and Paul have been thinking about as well.
Yeah, it did, and I think a lot of the things you said there, I mean, it makes a lot of sense, but doesn't it really sound like that somebody has built these financial instruments that are accessed without any know your customer basis on the kind of starting side? And I mean, what does it mean from a kind of regular consumer perspective? Let's put it that way. So let's say, take a step back again. If I'm an investor and I'm interested in decentralized finance, how can I actually get involved? Where do I find these things? And how could I actually interact with decentralized finance if I'm a regular non-institutional investor?
Yeah, I know that's a great question that oftentimes comes up, and the regular answer is just go and read into Google. But I'll tell you a few things that if you were to simply borrow the constructs from your existing world, we have mobile apps that allows us to check our accounts. Equivalent of that is a wallet. Our mobile account tells us how much money we have in respective accounts, whether it's savings and checking and various sort of account structures that we maintain. My investment banking tells me what kind of securities I own. My 401k tells me. So these are all sort of constructs, and I'm using mobile apps to check these things and manage whether buying and selling and moving of these things of value or assets that I have in my portfolio. Similarly, the constructs in the DeFi world revolves around a wallet of sorts. A wallet basically, instead of giving you simply account information, they allow for a few things. So there are centralized exchanges like Coinbase that give you the sense of wallet, but they are no different, let's say, for example, what wallets a bank will give you. But then in many cases, the wallet are actually also custodians of the digital assets, which means they not only show you the information about what you own, but they become sort of the element that lets you own and hold on to these assets, which historically you've trusted your bank to do it for you. Now that fundamental shift of how we view in terms of accountability and responsibility, that if I'm owning my assets, I have certain accountability of preserving my password, preserving the seeds that go with keeping that asset safe, which in the clunky world of crypto assets, you deal with private public keys and the notion of private key, which make it a bit more complicated for a common user. So there have been a lot of projects, including some of the open projects that allow you to create a mobile wallet. And there are some of the projects that allow you to connect, especially the DeFi protocols, which is the Lego blocks, allow you to connect to this wallet and be able to move assets in and out of the wallet. So for common people, I think the first thing is education. You don't want to get into it and risk the asset and lose the asset in some cases because of ignorance. So there's a certain level of education to understanding the constructs of what does it mean to own an asset? What does it mean to own a wallet? How does a wallet in this space differ from a typical digital wallet provided by your payment provider like PayPal or your bank that lets you account? And second thing is participation and the risks involved in this economy. It's still an emerging space. There are technical challenges, there are business challenges, there's fundamental language, there's a different lingo, as you know, crypto industry uses. I think that spending some time in understanding the language, the risks, the space is the first step I would go with. And the second step is there's no better way than to immerse yourself, which means open a small account, even if it means you open an account with centralized exchanges and begin to buy and sell these tokens at a very small scale, that the amount of money you want to put in, you're willing to lose, with that mindset as a tuition fee to learn. So start small, and as the understanding goes up, both of risk and technology and the space, then you sort of slowly move in. So I would say it's a phased incremental approach, starting with education, if that makes sense.
So there's an interesting discussion to be had here around decentralized finance versus what we are traditionally used to. If a consumer is to move into the world of decentralized finance, they also, whilst they get with that this element of maybe being able to hide their identity, transparency, etc., they don't have any of the backing that you get with the existing monetary systems, right? If you lose your money, you get no way of getting your money back. If someone manages to fraudulently get your tokens, you're not covered in any way. I'm assuming there is, like you said, educational elements that have to be pointed out here. decentralized finance and cryptocurrencies aren't the same as existing money and existing currencies, right?
Yeah, and I think, Ville, I forgot to mention that you did mention the whole element of KYC and identity, right? It's a big part of the whole thing. And I think when you open a bank account, a few things they do is check who you are, whether it's passport, driver's license, and that ties to identity. That defines who you are. And there is pluses and minuses to that you're giving up your identity, but you're also getting some of the fiduciary responsibilities that banks have towards its consumer. So you have investor protection, you have protection as a consumer, that if there's a certain element of, and there's a small fee that you pay for those services. When you move into DeFi space, there are two angles to this. One is you can go all native, which is bank of Paul can take all these Lego pieces and create this own Lego pieces, create your own disintermediate finance, which means you're not dealing with any intermediaries, you're taking accountability. And when you start taking that level of accountability on your own, it comes with certain responsibility, which means you're responsible, you're educated, you're informed about the risks that you're taking. But at the same time, there are risks both from regulatory and technical risk that goes with it. And I think you see many of the platforms that are emerging that provide identity services, whether it's self-sovereign identity that's tied to a wallet, both for purposes of taxation, but also for purposes of financial crimes, that many of these open protocols or these Lego blocks that are emerging are required to do not just as a best practice, but also if they choose to get into institutional space, that becomes sort of a foundational requirement. So the notion of digital identity is a double-edged sword that while you have the sense of preserving your privacy and preserving anonymity on the network, which gives you certain flexibility, you also lose out on some of the fiduciary responsibility that the third-party bank or a traditional regulated banks provide to you. And then you take on the responsibility of managing your funds and managing the risk, which oftentimes not everybody's cup of tea. I mean, oftentimes, including us, all of us, we are educated, well-informed people, but I still think twice as I'm experimenting and making my headway into DeFi world. What is my risk of me collateralizing my crypto, for example? Will I ever see it again? And what happens if the technical risks ensues and I lose that crypto asset? I really have no recourse. I cannot go to one of the regulatory bodies and complain about it because that's a risk I have assumed. So you have to take that with a grain of salt and understand both sides of that equation as this evolves, I think.
So one of the ways, or I guess you could say almost like the only way to invest into DeFi protocols is through something called stablecoins, which we have discussed many times. And the reason for this, as we understand it, is that there are no direct ramps from the existing fiat money world into the world of DeFi. You actually have to use this kind of a bridge that is the stablecoin. And there are many out there, USDC, USDT, many others are available. Now, Nitin, why do you think this is? Why do you think we are not able to transfer money directly into DeFi? Why do we need these stablecoins to make this happen?
That's, I think, one of the most brilliant questions that have been asked. And oftentimes there's a lot of depth to this question. I just got off a call on figuring out the genesis of stablecoins. So if you look at the Tether, the first stablecoin that came in 2014, we were chastising stablecoin. We in the industry saying, hey, the whole point of crypto industry is to get away from traditional finance, and we should be able to deal with crypto assets and treat crypto assets as local native liquid assets like Ethereum and Bitcoin. But remember this, right? That there's the value that Ether and Bitcoin and like protocols, and there are, gosh, up to 800 plus different protocols today. So it's hard to keep track of those things. But nonetheless, the value many of these tokens get is from crypto economic system, which is mining or minting or staking your crypto assets, and it either multiplies or the demand goes up because of the ecosystem emerging on these. And there are n number of crypto economic systems at play that gives these things a value. Now, for common people who are not either attuned to or don't have the infrastructure for mining or staking, for them to participate, you needed some instrument for them to buy into it. And we are dealing with two economic systems, one that's constrained to the crypto economic system, and one is the outer economic system that we all live and survive and buy our breads and buy our homes with. So the whole idea is using fiat as a medium of exchange to make an entry into crypto was one of the reasons why stablecoin was introduced, is the ability for me and you to simply go and use our banking rails to go and buy X amount of tokens for us to participate, even though we may not want to participate in the crypto economic, the foundational structure that creates and subsumes these tokens. And that's data point number one. Data point number two is stablecoin also became a necessity. That if you look at crypto space, it never sleeps. It's 24/7. It's moving at the speed of electrons, literally, 7 seconds for processing a transaction and anywhere in the world. So these are truly global systems. So if you had Ether, for example, or you had Algorand, or you have any of these tokens, which are treated as liquid tokens, anywhere in the world, you can still participate in the DeFi or crypto economic systems simply by using that as an avenue for exchange of other tokens and other assets, right? And it doesn't really matter what's your citizenship, what country you're in, as long as you have Ether, which became a currency of the system, or Bitcoin, or any of the known sort of high valued crypto assets. But you did need stablecoin to provide a fungible asset as a mechanism to be able to cash things out, so to speak. And so stablecoin became a necessity, which later on was in question with central banks and payment systems and payment designers and so on and so forth in terms of the regulatory question mark against stablecoin. But stablecoin was born of necessity to provide the fungible unit of exchange in this large crypto and also facilitate a participation from the common people who understand money and have the capital to bring liquidity and fungibility into this ecosystem. So that's why I think stablecoin are born. But I see a future, whether you're looking at CBDC or central bank digital currency issued by a central bank, or in the DeFi space, just by keeping the most valued tokens like Bitcoin, Ether, Cardanos of the world, and using them as a fungible layer one instrument for settlement. I'll stop at that. A lot to unpack there. Would love to get your thoughts.
Paul, anything to add?
No, I mean, I'm still stuck in the trying to understand the totality of stablecoins, right? Particularly when you start looking at I can understand stablecoins from the perspective of giving a lower level of volatility against the value of that asset, right? When you look at cryptocurrencies, we all agree that they are fairly volatile, and therefore in some way or another treating them as an equivalent of cash becomes very difficult, particularly when you start looking at smaller transactions. But at the same time, if you look at the stable coins, once they're in circulation and people start creating trading pairs between crypto assets and stable coins on exchanges, you start getting into a space where you can, for all intents and purposes, manipulate the value of a stable coin on a specific exchange. So doesn't that start begging the question of, stable coins becoming a mechanism for people to basically arbitrage or manipulate the system to make profit out of something that should remain stable? To me, it's the system breaking itself because people are playing the game, right?
That's an interesting perspective, Paul. So that question begs, how does stablecoin derive its value? So I'm going to go into a little bit back in time in terms of how stablecoins evolved. Besides the business case, there are three foundational models that stablecoin rely upon. The first model is what banks that we all work with is centralized IOU model. So IOUs are fairly well-known instruments in financial systems. We give IOUs all the time, whether it's form of a credit or form of a commercial paper. And IOUs are something which, which is the first model, which means that a stable coin is backed by a stable asset.
Right, yes.
So stable coin is backed by, when I say stable asset, think of it as basket currencies, USD, GBP, yen, and so on and so forth. And which means that if I'm backing a stable coin with an unstable currency, then it's not exactly a stable coin because you're dealing with volatility of the value of the coin itself, leave alone the fungibility of an exchange mechanism of that coin with other crypto assets. Yes. So centralized IOU is first model, which is the most common, widely accepted by financial institutions, regulators to say, as long as you're keeping $1 or a yen or a euro behind this coin, I will treat the coin as a payment instrument and I'll move on with life. And as long as you can prove with some regulated method that there is a guarantee behind those assets, that no one's mucking with the asset, which is what's come in the news quite a bit. The second model is value on chain. And this becomes interesting where until a crypto asset becomes liquid enough or stable enough, how do we keep value on chain? And I think there've been many projects like DAI, like MakerDAI, for example, which sort of creates, which tries to peg a crypto asset to a USD to maintain a stable value. And the value is controlled by the issuance and burning of Ether on one side. And those projects aiming to be able to use a medium of exchange and being able to collateralize your crypto assets. So this is value on chain, which means I'm not relying upon an off-chain, securing an asset and collateralizing an asset, but I'm keeping value on chain, which allows me to not have to deal with banking systems, which is where I think the crypto world is heading into because of the regulatory pressures and so on, so that goes with it. And the third model is what we're calling synergy model, which is the use of algorithmic systems to maintain demand and supply of these coins that maintain stability. Exactly what central banks do in our economy is control the money supply to maintain monetary stability and financial stability of the systems in the picture. The third model is deemed illegal in many countries only because there is a certain element of sovereign control on demand and supply of money supply. This is the M0 and M1 essentially in many countries. And then you look into the secondary model, which is value on chain. And most of the folks are looking at value on chain as one way to outmaneuver the regulatory system, which means if you don't touch the crypto world to a USD or to GBP or euro, then it becomes hard to enforce regulatory frameworks on these systems. Right. But the most common one is centralized IOU, which basically is becoming a de facto real-time payment systems from that perspective. So I wouldn't call that manipulative in the first model, which is the most common model, but I would say that the mapping of the crypto to any of the cryptocurrencies allow us to apply the lens of valuation from the existing world perspective, which to me is a transitory phase till we become all abreast and know enough about crypto and we can begin to measure things in ETH. So you begin to see BTC ETH value pairs too, which has nothing to do with stablecoins per se. I'll pause at that to see if that makes sense.
Yeah, I mean, there's been a lot of discussions around stablecoins, and it's a very kind of hot topic at the moment. Everybody knows most people are aware of the controversies related to the centralized coins and the kind of structure of their reserves. I think there's a lot of interesting stories out there in terms of how much you can actually trust these institutions to maintain the peg in real world. However, that doesn't seem to be stopping their growth right now. It's also interesting the kind of stable coins like the MakerDAO or DAI, which is now largely based on USDC, which is actually the category #1 stable asset. So it's kind of becoming a mix. And as far as the algorithmic stable coins are, I mean, they are interesting experiments, but practically all of them have failed. Right now, so nobody has been able to kind of crack that code yet. But let me actually move us on to the next kind of thing you kind of mentioned there in the end of your answer, which is that people want to move to these on-chain native assets in order to avoid being regulated. Now, avoiding being regulated, I mean, is that the thing that decentralized finance wants to do? So they want to avoid regulation, or are they actually looking ways to move towards being regulated and therefore more perhaps accepted by traditional finance?
Yeah, when I came to this podcast, Paul told me this is going to be easy, but obviously the questions are very probing and very so thank you for that question, Ville. So 2 weeks back, as you know, there was a massive fiasco in the US legal system and Congress in terms of understanding the crypto assets and finding some regulatory framework around it, which I think, in my opinion, as an American, we are a little bit behind from, let's say, Europe, who had a fairly robust and progressive, I would say, crypto regulatory and regime in terms of understanding this and passing meaningful laws and regulations. And I'll tell you this, that the lens that's been applied today is both from, and I use the 3 I's, infrastructure, instrument, and insights, right? We are applying the same lens for regulating this industry, which is innovative, has broken many models, and I don't think you can retrofit the existing banking infrastructure that has been almost 100 plus years old. And while we have digitized it, the foundation of banking has not changed. We still rely upon deposits and lending and borrowing, and those constructs have not changed fundamentally. And so we are applying the same lens to this new world. And what the second model will do, which is what we are proposing, is if we don't touch the existing financial system, then the regulatory bodies around the world will be forced to look at this in its native form, which is truly meant to obliterate barriers, enable financial inclusion. And we oftentimes compare what internet has done for information. Blockchain and DLT technologies do that for things of value, is open up a global marketplace, a global ecosystem, which means you control the endpoints, not the network and not the system, and let it evolve from an innovation perspective. And survival of the fittest. I mean, there are bad projects which will eventually fade away because they are bad. The economic system will dry them out, and you focus on making regulation that makes sense. So the debate that ensued in the US Congress was a joke and is reflective of the understanding of many of the lawmakers of what the system is. What are we trying to achieve here? And it's less about financial crimes. It's less about nefarious activities, because I think time and time again we've proven with recent $611 million hack that it's a lot easier to track and trace people in almost instant real time than you could do with the existing financial system, which is reliant upon cash and fragmented sort of ecosystem around it. So my pitch to saying outmaneuver, we're not trying to avoid regulation, because I think regulation is important. As Gary Gensler said, it's meant for investor protection. It's meant for protection of common people. So a few knowledgeable entities cannot take advantage of the common people, which is majority of us, like 90% of the world will use the system. So to prevent that, you need regulations. Regulation is not a bad thing. It's a great thing. I think it's a good thing that we need to embrace, but it has to be meaningful. Regulation has to be meaningful enforcement. And so outmaneuvering the regulation will force the regulatory bodies and the College of Regulators around the world to think differently about it. And that way, the notion of AML and KYC and all the things that we apply with the traditional lens of monitoring the endpoints and travel rule will have to be thought through differently in crypto space. And that's the point that we were trying to make in that case, if that makes sense.
I think we've repeatedly mentioned on our podcasts in the past, Ville, that a lot of disruptive innovation is very often driven by communities of people that either one, want to bypass regulations and undertake criminal activity, or two, by a demographic of people who really do, for the better of society, want to find a better way of doing things. I mean, we've spoken in the past about the journey of Spotify, file sharing and Pirate Bay and everything else, where very often the things that we take for granted today and is within inside of a regulatory framework has actually been born out of activities and technologies that have been driven on the cusp between accepted and non-accepted. And I for one believe that decentralized finance will drive towards something very good for us, particularly when we talk about the unbanked, etc. today. But we have to go through this journey, I think. Would you two agree?
Well, I think it was Andreas Antonopoulos that I heard saying in Slush conference in some years ago when he was speaking there about Bitcoin specifically, that everything interesting in the world started as illegal. And whether or not I subscribe to that ideology, there's some truth to it for sure. So yeah, I do agree. What do you think, Nitin?
No, absolutely. And I wouldn't go as far as calling it illegal. I think it's and what's interesting in this debate too was they were trying to include the developers, which is the sort of the core ecosystem, because a lot of stuff is all code. There's a moniker of code is law, and implementing code in the system enforces the protocol rules and regulations. And the question that came in US Congress was that, can we take developers to the fullest extent of law under the disguise of, or under classification of broker? And the question that we brought up was, writing code is free speech. It's equal to you writing anything you want to write is protected by Constitution. So how can you regulate free speech when it's immutable law in US Constitution, especially in terms of the fundamental rights? And so that was an interesting debate in terms of, by running a Bitcoin network, as to me as a technologist, I find some amazing stuff. I find that decentralized networks is bringing together the trifecta of the perfect storm of applying CPU memory and technology come together and using state machines to be able to spread the state, which to me is a great way to induce transparency, right? Is a great way to be able to propagate the state meaningfully. And that way all parties involved have the same version of truth, right? Again, the answer to everything is blockchain, right? But the whole point is that technology-wise, it's brilliant. It's brilliant for us. And all they have done is looked at that transformation and said, can we use this in financial systems? Can we use this in supply chain? Can we use this in healthcare? And ironically, we talk about financial services because it's a heavily regulated industry, but we haven't really, no one's questioned the use of technology for supply chain with the same rigor and same sort of force that you have questioned the decentralized and open networks and decentralized finance. And that is telling of the time that technology does have its purpose. We simply have to separate the activity than from technology. And that is an important differentiation I would like to draw upon, if that makes sense.
Great. Let's switch gears a little bit as we're drawing to the end here. And there's one thing we need to address in this whole conversation. If you look at the companies working in the DeFi space and offering products for people to invest in, and then you see these asset prices going up and up and up and up, everybody seems to be making infinite amount of free money investing in this space. Yet, for somebody looking from the outside and looking at the system, it's a little bit hard to understand where that value is actually coming from. I mean, for sure, some people are getting money out and they are buying their Lamborghinis and driving them across cities, as we've seen in some videos lately. But it's hard to understand where that value is coming from. And let me kind of phrase this in form of a bit of a analogy that I completely welcome you to challenge as well, which is that maybe decentralized finance is like a casino. And as we discussed before, maybe stablecoins are like the cashier at the casino. So you go in, you give your dollars or euros to the cashier, they give you these chips that you can then use to go play at the table. So you can go play at blackjack, you can go play at the poker table. And then at the end of the day, you probably will lose most of the chips. But if you're lucky and skillful, you are able to get more chips. And then the way you kind of get back to real money is that you go back to the cashier, which in this analogy is again the stablecoin provider. And you ideally get your money back, and then you walk out a happy person being able to win something out of this. Now, what we're seeing right now is that people are not really cashing out at the moment. So they are kind of keeping their chips because they are increasing in value in one way or another. But again, what do you think of this analogy and this kind of way of creating more value, quote unquote, in this ecosystem? Is it sustainable? Are we missing something?
No, I think another great question, and it's going to be a long answer, so just bear with me for this moment, because I've listened to many of economists, including the ones who are pro and con, and many of the hedge fund managers. So let me start with saying that technology inherently is deflationary, right? Which means that technology starts out, and you can look at anything, right? Back in the day, starting from VCRs, though we all are dating ourselves because we used to use VCR. If you ask our kids, they're like, what the hell is that, right? From that era to media, to laptops, to iPhones, and while the iPhone's prices have gone up, the features and the processing power iPhone is much farther greater than Apollo 13, for example, right? So in many cases, technology itself is deflationary. So early days, you do have the element of the promise of this opportunity. And I have always refrained, and this is just Nitin's perspective, to compare both blockchain, Bitcoin, and the resulting ecosystem that are relying upon economic systems to casinos, because as it is, there's enough FUD and there's enough finger pointing at crypto assets, and comparing that to a casino makes it even worse, because next thing you know, but yes, you're right. There's some element of that gambling happening in this space to say, hey, I'm going to go invest in this NFT, and I don't see why people are paying X million for a JPEG, which I have written enough about NFTs and what NFT should be in terms of what gives any digital asset a value. So I always go back and asking myself that, one, value lies in the vault of the beholder, as a joke, but value lies in the eyes of the beholder is what I value and what I'm willing to pay for it is completely subjective, as opposed to what gives something a value. And if Bitcoin is valued a certain thing because it's become a store of value, it's become an avenue to provide promissory notes moving across the network. With NFT is still a very, very open space as to why JPEGs and images and movies as rights management to a certain access. But to me, it's still the Cambrian explosion, so to speak, of that space. It's growing, and no one wants to miss the boat, not realizing that all that eventually will be, these are all deflationary elements of deflationary assets per se. So what I'm focused on, and I actually written extensively on this topic, is the unicorns of this industry, the future of Amazons and Alibaba and Baidu and Tencents of this space is what my focus is. And so I'm extremely interested in what, for example, things like Aave and Uniswap are building, is building that true decentralized framework that allows interaction patterns, that allows now, especially with what Uniswap has done recently in building institutional products. Aave has done the same thing, building institutional products. Consensus had built an institutional MetaMask. And this is one way to sort of bring this to scale and bring some method to the madness, because right now, one big challenge in the industry is pricing. The data is not easily available, there's not egalitarian access to the data, which is where the existing financial market is able to equalize, because you have the efficient market hypothesis that if there is equal amount of information in the market, then market will reach an equilibrium in terms of how they price the asset. And that equation today is missing only because of the technical fragmentation of the space. I'll stop at that. There's a lot, again, to unpack there, but I've always refrained from casino analogy, because as it is, we're having a hard time having regulators understand the space. And when you start bringing casino analogy, it becomes even more harder for us to explain them that, yes, we can still do things for investor protection and protection of the common man who wishes to get into this. I
think the funny part here is that casinos are actually more regulated than DeFi at the moment. So, so that's also makes the perhaps a little bit more challenging. Any thoughts, Paul?
I was just, based on that analogy, what we're really saying is that anything in the DeFi space, in the crypto space, in the stablecoin space is an analogy of gambling or assets for short-term investment or to speculate. We're not talking around the exchange of stable coins in a decentralized finance environment to undertake normal day-to-day transactions. I mean, I read an awful lot of use cases around, decentralized finance being used for loans, decentralized finance being used for insurance, and other what we see as being general everyday financial products. So I'm wondering, based on your analogy, are we heading into a direction where decentralized finance will always be some sort of speculative investment product? Or do we see decentralized finance merging with embedded finance towards, society 5.0, where we in the future will have a hybrid of decentralized financed products, central bank digital currency, and cash and normal banking capabilities that merge into some sort of hybrid future vision for us as general citizens?
That's a very profound thought, Paul. And I think we both had worked in Society 5.0 paper, as you know, in what is the future of the society, as in, from IBM research and sourcing the talent such as yourself from all over the globe. So I would go with latter. I think there'll be an integration of the existing world, because existing world exists. We have $271 trillion plus worth of sort of assets in that space. The digital world is emerging. So I would go with your latter thought process that, to me, this is an evolutionary process of addressing the digital need and progressing the humankind in terms of going to the next era, the next century of how we choose to transact and what we choose to treat things of value. Because over time, the definition of the value has changed and shifted, right? And whether it's my identity or whether it's my healthcare tied to my identity, to me, is a true NFT that I can monetize that space by lending that NFT, which is unique. It belongs to me. Nobody can steal it. Well, they can steal it, but they can't really use it because it's really mine. They can misuse it. that is true definition of ID as NFT as opposed to JPEG, and extending that to clinical trials and insurance company to monetize that space and me monetizing it. You need that digital ecosystem to bring the fungible, non-fungible asset to the same. And this is where, what we're building. So while we are starting with the digitization of existing asset classes that we understand and know and have the risk models for, I think that the emergence of new asset classes that are emerging is going to be the disruptive force that's going to drag along the existing world with it into the next era of financial services, I think.
And on that thought, we have a saying here on Fintech Daydreaming that time flies when you're having fun. And that means that we are coming to a close of yet another episode of our podcast. It's been a fantastic discussion. I think a lot of people that perhaps didn't know much about decentralized finance should be now more educated on the topic at least, and be able to start looking for things that have been mentioned in this podcast, starting from the episode we did earlier about NFTs, where we talked with, for example, with Dave Birch earlier, a good amount about non-fungible tokens, what they are and what they are perhaps not. So feel free to go back and look at that. But with that, Nitin, again, thank you so much for being on. Paul and I would like to give you a chance to let the listeners know, first of all, any concluding thoughts, and then how can they get in touch with you if they want to have a further discussion about any of the topics we talked about? So
just concluding thought, thank you both for this fun conversation. And I don't know how the whole hour flew by. And I think what you're doing is something which I think is such an essential part of spreading awareness and bringing a bunch of us to the same table to have this conversation, which is much needed, especially at this phase of this massive exponential growth and a lot of FUD factor that's out there. So you are performing a real essential public service, so to speak. So thank you for your invite. But I would actually ask the audience to reach out to any one of us, read more about it, understand the space. It's a lot of exciting work happening in the space. And you can connect with me via LinkedIn, which is the easiest path. And let's take the conversation there, I think. All right. So thank you again for the invitation.
Thanks for the kind words, and I couldn't agree more. Now, dear listeners, whether you're watching us on YouTube or listening to us on any of your other devices, all of these platforms have one thing in common. They have a button called subscribe. Please hit the button if you haven't done so already. Subscribe to the channel. You will get all of the episodes of Fintech Daydreaming, and you will get a new episode every 2 weeks. So hit subscribe.
On that a little bit, Ville, and say, and please hop over to the YouTube channel and hit the subscribe button, because we really want to grow our following base on YouTube, right?
Exactly. So however you do it, do prefer YouTube over the others, perhaps. So that being said, Paul and I will be back in 2 weeks with another guest to talk about all things fintech, and we will see you again in 2 weeks. This has been Fintech Daydreaming.
This is Fintech Daydreaming.